Yeah, hi friends, can you hear me? Am I audible? Okay, let's start. This session is on just recapping you towards all of the FRM concepts which are very important from the exam perspective. Okay, and I know a lot of people should have doubts some or other concept. So what best you can do is you may have content related doubts, so that you can just mail it to me. Okay, just give my ID. It is Shreyas at EduPristine.com. It's Shreyas at EduPristine. Whatever content related issues, you can mail it to me at Shreyas at EduPristine.com. That is SHREYASH at EduPristine.com. Okay. And if you want to know about the offerings, whatever related to EduPristine, you can mail it to Austin, AUSTIN at EduPristine.com. Okay. So it's AUSTIN at edupristine.com. Okay, so let's start. I'll take all the 4 modules with you. I'll start with the foundations right now. Okay, and one more thing, if you have anything to ask related to any exam specific doubts which can be taken up easily, that you have a question box with you, you can write it there. That will be answered immediately. Okay, so let's start. Okay, what we have done is we have taken some important formulas out of this. Okay, which are some important topics which are very frequently asked in the past previous FRM examinations, and we'll just discuss that with you. Okay, so let's start. Number down the points which you need to remember from the exam point of view. Take it the efficient frontier. Okay, it is the optimal portfolio plotted along the curve that have the highest expected return possible for a given amount of risk. So whenever, first of all, you see a question on efficient frontier, just draw the graph. Okay, draw the efficient frontier. Okay, on the y-axis you have the returns. Okay, and on the x-axis you have the risk, or what you call the volatility or the standard deviation. Okay, I'll take one by one point immediately. Okay, capital market line. Remember this formula. This is something very important. Okay, remember this formula. This is the capital market line formula. This will be very useful when you need to take out the return for the expected return of the portfolio. So when you are evaluating, this formula plays an important role. It is a combination of the risk-free return minus the risk-free return gets subtracted from the portfolio return into the standard deviation of the portfolio into the standard deviation of market. Okay, another formula which is beta, a concept which is very important from all the 4 modules, especially in foundations and Conts, that is covariance of return on asset I and the return on market. Okay, upon the variance of market. Never confuse yourself with standard deviation and variance. Keep this point very important. Just to confuse you, you'll just be given the volatility. Okay, but you will not be given the variance. So you have to square it to get the variance. Fair? Market risk greater than as predicted by CAPM if the correlation between return and inflation is positive. You remember the multi-beta CAPM? That's the important note part of the non-standard CAPM. Risk can be classified into operational risk, finance risk. What is finance risk? That's the credit risk, okay, and market risk. Okay, so you have to keep in mind this 3 kind of risk. It's very means what you call very from a brief point of view from risk management, but this gets in more depth when you look at FRM2. Enterprise risk management. Okay, enterprise risk management emphasizes a comprehensive holistic approach to managing risk. shifting away from the siloed approach of separately handling each organizational risk. Why this is the integrated risk management approach rather than you taking individual risk, okay, of the organization. So enterprise risk, the important point is the integrated risk management. Okay, problems with beta. To remember these points, you will be surely tested somewhere directly on how beta is beta's limitations. It is backward looking because it is based on the historical data. It is estimated with error. Okay, this term is very common in when you take quantitative methods. Okay, dependent on how the regression is structured and whether the stock is publicly traded. Okay, so the important point to note is that the stock should be publicly traded, so to take out the beta of a stock, because the returns are regressed with the market returns. Four steps in the ERMIC risk management approach, that is the Association of Insurance and Risk Managers in Industry and Commerce, and it is one of the approach to enterprise risk management. Keep this point important. It is one of the approach to enterprise ERM. Okay, MEC. Okay, it is the identification of risk management and enterprise objectives, risk assessment, risk treatment, and risk monitoring. Okay, you have to be very clear on all the 4 points because this question will be asked on the process of MEC. Fair. Poor data can impact your financials. Very true. Okay, and this is the limitations of what poor data can have on your financials. That increases your operating costs, that increases your penalties. Okay, and delays in cash flows. Okay, GARP code of conduct. This is these are the ethics which have to be followed by any members and members and the candidates of FRM Institute or the GARP Institute. These are something very important. That is professional integrity and ethical conduct. Okay, you have to be very professional in your day-to-day reporting. Okay, conflict of interest. The conflict of interest can be with the clients. It can be with your employer. Okay, confidentiality. You have to keep the confidentiality of your clients. That's a very important point to remember, and somehow this will be tested. Okay, fundamental responsibilities. You give a fair view on whatever reports, whatever your views, your opinions are, you give a fair view on that. Yeah, okay, and adherence to generally accepted practice of the risk management, practices of risk management. As a student GARP member, you need to follow this code of conduct. Sortino ratio. Part part of the calculating portfolio returns and the risk involved, and also the performance measurement of individual portfolios. The important point to keep in mind is the semi-standard deviation is used in the calculation of Sortino ratio. What is semi-standard deviation? It measures the variability of only those returns that fall below the minimum acceptable return. Okay, so whatever returns falling below the MAR or the minimum acceptable returns, only that are taken into consideration, and we calculate the semi-standard deviation, that is the SSD. Stack and roll strategy was used in Metagal-Chef's case. Okay, what happened is Metagal-Chef case, how the crisis happened for Metagal-Chef was it bought a huge quantity of futures contract of same expiry, and it liquidated prior to expiry, and it later on rolled over it to another huge quantity of long contracts of a longer expiry. The huge quantity is known as stack, and the roll is when it roll over by selling over the near month contracts and then later on buying the longer term contracts. Okay, LTCM was a hedge fund using highly leveraged arbitrage trading activities in the fixed income in addition to trading passive. It had huge derivatives position globally. First of all, its leverage ratio was from somewhere near 28 is to 1. Okay, that is debt. That is the overall what you call exposure, and towards its equity was huge. That's why there was a collapse in LTCM. Nick Leeson, there's a clear trade of operational risk. Okay, uh, of a trade at Barings Bank led to failure of the one of the oldest bank in UK, Barings Bank. Okay, it took speculative positions to cover prior trading loss due to little or no risk management interference. So these are some of the very important points you need to remember from the foundations of risk management module. Okay, you need to remember these points. If you keep these points and if you are very clear on this concept, you can score a good you can score very well in your foundations module. I'll take up the quantitative methods module now with you. Okay, since quantitative methods, another important module, it carries a weightage of 20% in the FRM-I exam. I forgot to mention that even foundations carries a 20% weightage in the FRM-I exam. Same is for quantitative methods. You need to remember some of the important formulas here. Say, suppose this is for let's take down each and individual readings first. Take it probability. Okay, if you understand the question and the basic formula of probability, which is favorable outcome, that is the probability of an event to occur upon the total outcome, you can easily answer each and every question of probability. Okay, fair. Uh, Second point, to solve conditional probability, you must understand Bayes theorem, which is quite important. Okay, you can see that there are two ways you can solve the Bayes theorem questions. One is to remember the formula. I don't know how easy is that. Okay. The second way is to use a tree diagram. If you understand the tree diagram properly, you will be able to solve most of the questions. Okay. Suppose I'll just give a brief example. This is a market situation. Okay, you're told to calculate the probability in three different conditions: the bad condition, the good condition of the market, and the worst condition. A bad condition, a good condition, and a neutral. Okay, this is the way you can solve the Bayes theorem. Create a tree and most of the questions can be solved. Okay, never forget two basic properties of probability. Probability of A plus B plus probability of C and so on is equal to 1. Okay, and probability of any event lies between 0 and 1. These are some of the important properties of probability you should keep in mind. Basic statistics, another reading from the quantitative methods. Okay, take up all the points. It is important to note that we need to use n when we are calculating a population standard deviation. Okay, that is summation of x minus x bar whole square upon n when it's a population. Okay, and when it's a sample standard deviation, when you are given a sample, to calculate the standard deviation, it is n minus 1 is the point you should keep in mind. Whenever in the question volatility is meant, it means standard deviation, not variance. This point I talked earlier also, that keep in mind that volatility means standard deviation and not variance. Okay. Another point, quick way to solve some questions on progressions is always to remember that arithmetic mean is greater than geometric mean, which is greater than the harmonic mean. Okay. You need to understand the conceptual difference between geometric mean and the arithmetic mean. This can be understood, but what the question is asking you. Suppose take an example of CAGR. Okay, if they are asking for a compounded annual growth rate of a data given, then the best method would be using geometric mean. And suppose you have to calculate the average age, the arithmetic mean will be more useful. Another important, many participants get confused between covariance and correlation. Always remember the relationship between two and how you can convert the first to second. This formula, variance of AX plus BI, okay, this gives you a very important understanding of the portfolio VA. What you can do is, if you take it this way, if you remember the covariance formula, okay, it's standard deviation of X, okay, into standard deviation of Y, okay, into correlation of X and Y. Okay. Okay, this is very important when the covariance is not given to you, and you need to use as an input, especially in the standard deviation of the portfolio. This do not undermine the importance of skewness, and understand what kind of data can have negative skew and positive skew. You just need to imagine the graph in front of you of the negative skewness, kurtosis, positive skewness. You can easily answer the question very easily. Okay, there are some new topics added, that is co-skewness and co-skew. You need to master them because they are new and there's a sure chance they can be tested. Though, what I'll give a brief of co-skewness and co-kurtosis. The mean and variance of a set of variable can have same mean, okay, but when combined in a different set, they may not have same skewness. Why? Since the ranking, okay, the ranking of the values may differ from for these two variables at different point of time. So the ranking makes a major difference why the co-skewness and co-skewness cannot be same when the mean is actually same. When the mean is actually same. Okay. One of the important topic, distribution and hypothesis testing. You have to understand that in detail about the random variable. That's an uncertain number. Good understanding of the random variable. Many of the questions are tested on binomial distribution. You'll be surely taken a question on somewhere on binomial distribution. Okay, so take some the best way is to take some examples on it rather than just mugging up the formula. Okay, take up the understanding by just referring many examples. So I think binomial distribution will give you a good understanding. Okay, whenever you get any question on normal distribution, you have to draw a rough diagram. That's the basic rule. Okay, draw the graph here of normal distribution. Okay, you have to remember these deviations. Okay, here's the expected value. Okay, the -2 standard deviation. Okay, standard deviation minus standard deviation, 2 standard deviation. Okay, 68%. Okay, I think it is clear now. I was just saying that we draw a normal distribution. Okay, we take up that the standard deviation. Okay, the negative standard deviation here, my negative standard deviation here. We draw and a positive standard deviation here. Okay, so I was saying that the 68% of the outcomes are within one standard deviation of the expected value. Fine, and 95% of the outcomes are within two standard deviation of the expected value. Keep this diagram in mind and you'll be able to solve a lot of queries on normal distribution wherever you get confused. Okay, we can move to next topic, that is linear regression. Okay, you have to keep some important properties in mind of a random error component, that is ordinary least square. Since most of the properties are related to random error. Okay, so for some of the important properties, I'll just say it out. Okay, there's a linear relationship between the dependent and the independent variables. Okay, independent variables are not random. There's no exact relationship between any two or more independent variables. Okay, expected value of the error term is 0. This is very important to keep in mind. The variance of error term is constant. When it is not, there is a heteroscedasticity. Okay, there's no correlation between two error observations. Okay, and the error term is normally distributed. Keep these properties in mind. These are very important, and you will be tested somewhere at the Cont section on this. Okay, you'll be surely tested on the R square. Okay, the relation between TSS, this is total variation, ESS and SSR. Okay, and you'll be told to take out the take out the value of R square and the adjusted square R square. So you have to keep this relationship important. This important relationship in mind, and you can very well solve the questions on R square. This is very easy. You just have to be very much take up this way, that the TSS is equal to ESS plus SSR. Okay, or sum of square errors. Okay, this way you can remember the formula on TSS and you will be able to score R square. It is important to know the difference between conditional and unconditional heteroscedasticity. What is heteroscedasticity? When the variance of residuals is not constant. Okay, and I'll just briefly give you conditional heteroscedasticity is variance of residual term increases uh, as the number of independent variable increases. Okay, and then conditional heteroscedasticity means the variance of the residual terms may increase or decrease with the increase of independent variables. Keep this one in mind. You'll be somehow confused on the conditional and unconditional heteroscedasticity. Okay, multicollinearity, that is, there is a linear relationship between or there is a correlation between the independent variables. This is assumed that there is no linear relationship between the independent variables. When this happens, it's the assumptions of the model is not helpful, the regression model. So you have to keep in mind the concept of multicollinearity. Okay. EWM and GARCH, I think you will surely get one or other question which will test you on. You will surely see a question which will test you on EWMA and GARCH. Okay, you'll be given previous volatilities, and you'll be okay. This topic is also covered in the VAR section. Uh, okay. Okay, I think everybody is now able to see the screen. Are you able to see the screen now? I think there's a problem with many of them. You're not able to view the screen. Okay. Important topic from the exam perspective. EWM and gauge. The topic is also covered. Uh, okay, it is covered in the VAR concept of the concept of mean revision, and the speed of mean revision is very important from the gauge perspective. mean revision, if you remember the formula for GARCH, it is the long-term variance multiplied by the gamma plus alpha into the square returns, okay, plus beta into the square volatility, that is a variance, okay. So the long-term variance into gamma is the omega, okay. So this point you have to keep in mind. And another important point is alpha plus beta plus gamma is equal to 1. Okay. EWMA, we give higher weights to recent observations. What are the weighted section is? It is called the lambda. Okay. Because what happened yesterday is more important than what happened 5 years ago. So we get, I would say, the weightage assigned to the recent volatility is given a high preference than the preference given to the. Okay, so the weightage given to the latest returns or the latest volatility is high, and compared to previous returns, just to model the future volatility. So this points you have to remember from the exam perspective. Okay, please remember the formula. I hope you will see very simple examples when you take it, when you remember the formulas. That's just estimating the volatility, and the questions are very easy on it. So keep the formula in mind. And then the best way is to practice some questions, and you can easily remember the formula. I'll take up FMP, the next section. Okay. Uh, some easy points to remember in FMP, and uh, your life would be easy. There is a lot of confusion between futures and forward. Okay. This point needs to be kept in mind. Over the counter has no immediately and no standardized contracts. So, okay. So what you can do is you can prepare the OTC, over the counter market, which so what I was saying is the OTC market, there you can customize the contracts. That you have to keep this difference very much in point, that OTC market is not a customized market. OTC market is more customized. It is not regulated. So this market is very much freely traded compared to a regulated market, that is the future market. Clearing houses play an important role in the financial transactions. You can see there's they take up the margins, they settle the securities, they settle your derivatives contracts, the pay in and payouts. Okay. So if you take the variation margin is the additional margin required to deposit on margin call to make the amount equal to initial margin. First of all, you take a derivative contract, you have to initially deposit some amount with them. That is the initial margin. Okay. Then what happens is there is a maintenance margin, which has to be always every time you take a derivative, has to be always maintained. If you fall below that maintenance margin, okay, you have to fill your account again with the initial margin, and that margin which you fill is called the variation margin. So keep in mind that initial margin, maintenance margin, and variation margin. These are three different things. Okay, the initial margin is at the start of the contract. Maintenance is when, if the suppose the future contracts, you're long on a future contract and starts falling. Okay, so you lose some money, your margin gets reduced day by day, and if the margin falls below the maintenance margin, that has to be refilled and get back to the initial margin. That point is called the variation margin. Keep this point in mind. A lot of people get confused on this, and a simple calculation of variation initial margins are just not scored. Okay, you can expect at least one question on basis risk. The basic idea is to understand what is basis risk is when there is not a perfect hedge. Okay, the derivatives contract you are using and the underlying asset is totally different. Okay, uh, optimal hedge ratio. Okay, used to hedge between a asset and using a derivatives contract or using a futures contract. Okay, you can take out the hedge ratio. The formula is correlation into uh, standard deviation of the asset upon the standard deviation of the futures. Okay, and you can also take out the optimal number of contracts, and the formula is beta into asset value upon the futures contract value. Okay, how can you take out the futures contract value? Is the contract quantity, okay, into the value of the contract, okay, or the price of the contract. This way you will get the value of the contract, okay, and that's divided by the asset value multiplied by the beta, and you get the optimal number of contracts to be hedged. Okay, the main difference between future and forward is that future is traded on the exchange and the forward is traded over the counter. That's the big major difference between a future and forward contract. Okay, if you understand this difference between exchange and over the counter market, you know the difference between future and forward. Then you can understand what is customized, okay, what is standardized, what is regulated. These points can be easily understood. In determining the forward price, you understand the concept of income and cost. You will be able to do every type of forward price. Okay, so suppose I take a commodity. The important cost involved is storage cost. Okay, and if we take from the income perspective, it is the convenience yield. Okay, and if I take it from a stock point of view, the main income is dividend. Okay, so this is the dividend yield, which is the income on a futures contract. A very important concept related to bonds, that is valuation of bonds, called it duration. All measures will be very important and they will be tested somehow in the exam one way or the other. One of the important, I'll take point wise for bonds. Okay, first of all, you need to draw a timeline to visualize the cash flows in a bond. Okay, so if I take it, I can show you a small timeline. Suppose there is a bond which has a maturity of 5 years. The initial maturity and the initial time, okay, time zero and the 5 years. Okay, then the present value and the future value, and what is the cash flows in between 1, 2, 3, 4, 5. These are the different cash flows involved in a bond. Okay, so you if you draw a timeline, it will be easily able to visualize the cash flow on a bond. Okay, when asked to find the yield maturity of a bond, okay, you'll be obviously tested on any concept, that is the present value, the future value, the payment, or the yield, or the number of years or the bond is due for maturity. So you can be tested on any of the concept. So first of all, you need to keep in mind, while you are asked to calculate the yield to maturity of a bond, don't forget to adjust the outcome of I yield on a calculator. Okay, based on the frequency. So suppose you're given a YTM of 5%, okay, and the frequency is semi-annual, so you have to divide it by 5 by 2. Fair. Similarly, number of years is told, okay, n is equal to 5 years, that's the maturity of bond, but the frequency is, I'll say, semi-annual again, so I'll divide it 5 into 2, that is 10 years. Okay, and this way I'll try to extract the yield to maturity, coupon payment, anything. So you have to keep the frequency in mind whenever you're taking a bond valuation question. Another important point is always put PMT is equal to 0 in case of zero coupon bonds, because there is no cash flow associated with one. The best part is to you always reset your calculator. If you your calculators, mostly many things will be very clear to you, and how, like, you will not be associated with the previous question you have calculated and the input values of that. So to always do is you reset your calculators at after each and every question. Okay. um, Important point to keep in this: Macaulay modified duration ignored the embed options in the bond, whereas effective duration calculation takes into account a bond embedded option, that is the callable bond. Okay, so this point you have to keep in mind. Okay, duration is good for small changes in yield and parallel shift in the yield curve. Okay, this is not the case since bond prices changes are not linear, but rather they are non-linear, and that's why the concept of convexity plays an important role whenever we try to take out the bond price changes. So it is the duration plus convexity, due to which we will try to measure the price changes based on uh, changes in yield to maturity. Okay, options. There's a difference between long call and short put. Long call is the right to buy, and short put is to obligation to buy. Keep this point in mind. Okay, options do confuse you a lot. Get a basic understand between what is a call and what is a put, and you will be very much clear. Call is getting long on a somehow getting long on a stock, and put is getting creating a short position on the stock. And then once you have the basic understanding of this, you'll be easily able to crack questions on call and put. Put call parity is an important concept, and it is applicable to European options. So it is the put plus the stock, okay, plus is equal to, that's equal to call plus the present value of the exercise price. Keep this point very much in mind. You will be able to solve questions on it. Sometimes you'll not be given out of this four of the values, and you have to take out the value of any of the four of the inputs. So this equation should be very much clear in your mind. Okay, remember the max profit and max loss of all option strategies. If you are not able to memorize, and which is very difficult sometimes, is graphs. Okay, take it this way, that what will be the absurd values of a stock, and then you can try to be calculate the loss and profit on any strategies, that is the bull spread, bear spread, calendar spread. So try to take an understanding on this. Okay. Delta is the most important option Greek. It is also considered as the probability of the option expiring in the money. Okay. Clear understanding, a basic understanding of this is change in call option price upon the change in the stock option price. This is how delta is calculated. You need to keep this point in your mind. So a lot of questions directly or indirectly will be tested, and if you understand that the formula on delta, okay, you'll be easily able to calculate many of the questions. You'll try to solve them. An option with large gamma has negative theta. Take this point, it is important. Okay. Okay, swaps forms an important part, and sometimes very difficult to calculate. Interest rate swaps can be used to change or transform a liability to asset, and vice versa. You take the best way is to take an example of a bond. Okay, you have issued a bond, and you are suppose a floating rate payer on it, and you expect that the interest rate to increase. Okay, you want to become a fixed rate payer. Okay, how you do that? Uh, just getting into a swap agreement, and you can transform your liabilities. Okay. in the valuation of interest rate swap, okay, one can consider it like long in fixed rate bond and short in a floating rate bond. I just discussed the example that the floating rate you have issued a floating rate bond, okay, and you expect that the interest rates will increase. That means you are short a floating rate bond, okay. So you want to get long on it. That is, you want to receive floating, okay, and pay fix. The, so understanding this, what you are receiving and what you're paying, okay. Whatever you're receiving is your long, okay. What is you're paying is short, and the best example to understand is through bonds, okay. And most of the questions will be tested this way because IRS, that is interest rate swaps, forms an important part of the of the swaps topic. Okay, currency swaps has most creditors. Same way, there is another important concept, that is currency swaps. This currency swaps also, what you can take it this way: which currency receiving and paying. Okay, on which currency you're paying interest on, or receiving interest, okay, that means you're long that currency, and on the currency you're paying interest, you're short that currency. So you have to understand how appreciation or depreciation of that currency will impact on your swap valuation, okay. So one of the important point to keep in mind is there is a credit risk involved in the currency swap because there is an exchange of principal, which is not the case in interest rate swap, where there is a notional principal. So the basic difference between interest rate and currency swaps has to be kept in mind. The the principal component, there is no exchange of principal in a IRS, but there is the exchange of principal in the currency swaps. After this, let's come to the last section, that is VAR. Okay. Uh, I just forgot to mention, but forms an 30% of your FRM syllabus, FMP, and same VAR forms a 30% of your syllabus. So these two are something very important. VAR is especially important because it is very important from the FRM2 perspective. A lot of basics get clear in from the FRM2 perspective. Okay, so you have to keep in mind that you're strong on your VAR calculations, and some important points so I'm discussing, you have to be very much be clear on that points. Okay, and VAR represents a maximum potential loss in the value of a portfolio of a financial instrument. Get the what exactly VAR calculates here. You have to be very much clear on that. What is VAR actually doing? Okay, it is calculating what percentage of your asset or what value of your asset can lose over a period of. Okay, so you have to understand what VAR calculates what an asset, how much your asset can lose a value over a period of time. So it can be on a daily basis, it can be annually, it can be semi-annually. It depends. VAR is very important concept. It's more related to your it can be operational VAR, credit VAR, or market risk VAR. The VAR calculation can be related to any of these losses, in calculation of these losses, and it is very important from FRM2 perspective. Okay, we calculated the standard deviation of the portfolio of a VAR. Okay, we calculated. If you remember, the standard deviation formula is this way. It's a weight 1 square into variance of asset A plus weight 2 into variance of asset B into 2 into the standard deviation of asset A into standard deviation of asset B. Uh, this formula is on the similar lines, but I would suggest the best way to take it is this way. You calculate the individual VAR for each and every asset. You will generally be given two assets and you'll be told to calculate the VAR of the portfolio. So my best way to tell you is take out first the individual VAR, so the absolute VAR. So the VAR of asset A, okay, the whole square, plus var of asset B, okay, the whole square, plus 2 into var of asset A, okay, into var of asset B into correlation, okay. This way you can calculate the portfolio VAR. This is the best way to calculate a portfolio, and portfolio VAR will generally be will be told to calculate in the absolute terms, not in the percentage terms. So this formula is much more conceptual in understanding, and you get rid of this kind of weightages. So try first take out the absolute VAR, square it for in this in the portfolio VAR, square it for asset A, square it for asset B, 2 into VAR of A and B into correlation. Fair? This is much more easy, and don't confuse yourself. Take up some examples. You'll be easily able to solve it. Okay, VAR can be measured with two methods. Okay, that is the linear method and the full revaluation method. So if I take it, it is the delta normal VAR, historical VAR, and the Monte Carlo simulation VAR. Okay, linear valuation does not uh, work for portfolios of non-linear security. Okay, that is the delta normal VAR is not helpful for non-linear security. What kind of your non-linear securities? That is the options. Okay, which don't have values below zero. Okay, so it's a non-linear security. Okay, there are two explanations of fat tails: conditional mean, that is the mean changing over the period of time, and the conditional volatility, that is the volatility changing over the period of time. Okay, keep these points in mind. They are very helpful from the exam perspective. Okay, full revaluation method accounts for non-linearity of derivatives. A very important point to, whereas delta normal method assumes a linear approximation. Keep this comparison in mind. It is also important to understand that it accounts for extreme fluctuations. These are some of the advantages of full evaluation method. You can be asked to understand on the to get an understanding, or you will be told to you will be told what are the advantages of full revaluation method. Okay, you will be surely tested on one question of historical simulation. The best way, they will give you random returns, okay, over a period of time, and they'll give you, and you have to arrange them in the ascending order. Keep this in mind. You have to arrange in the ascending order, otherwise you can easily lose a mark on a question which is so easy to calculate. Okay. Okay, you reviewed these points. I don't need to explain much on this. Okay, these are some of the points you have to keep in mind from the evaluators. Okay, this is very much given. If you understand this point, you're clear on this point, you will be able to understand most of the questions which are indirectly asked or which confuse you. So these are some of the direct points you have to keep in mind, and you'll be able to solve most of the questions on VAR, because it is very much theoretical. Okay, and this last point, since it is very theoretical, I'll just leave it for few minutes for you, and you just go through it. Hi guys, I think you must have gone through all the points. Okay, now I'll take up some questions that have been asked by you attendees out here. Okay, Abhinav asked that out of 100 questions, how many questions one should aim to get them corrected in order to pass the exam. Abhinav, if you're not aware how the results are calculated, it is on the quartile basis. Okay, so suppose there are 4 modules, you will be ranked on all the 4 modules compared to other students. Okay, you'll be ranked in each and every quartile for each and every module. So it is not over the overall of the exam, but rather for each and every module you have to score at your best, and you have to be best compared to other students. Take it this way, that if you are finding it tough in the exam, if you're finding VAR tough, it is tough any other individual. Okay. There is one question, since it's short, I'll take it. Adjusted R square is also required to remember. Bhavesh Kamdar, that he has asked it. Somehow it is important because it's the ANOVA table, that is the analysis of variance table. You can expect a question on adjusted R square. Okay. There is one question on mean revision model. Is it necessary to know by heart? Uh, you don't need to be by heart. If you practice some questions, you will surely be able to remember this. But you have to remember the properties of Gauge model, because you can expect some theory question on it. Okay. There are surely some questions on content related. You can mail it. It is shreyas@edupristine.com. Just note down. It is SHREYASH at edupristine.com. It's SHREYASH at edupristine.com. Shreyas@edupristine.com. Since there are some days left, and the best way to clear now is to take up some faster track study packages. I am sharing that with you. Okay. You have one FRM mock test and questions to check your preparation level. We give you 2 mock tests, 800 plus topic wise quizzes, and you have access to a discussion forum where you can raise your queries, whichever any type of queries, it will be answered. There's a complete package of webinar video tutorials and question bank. That is mock test, 50 hours of recording, 15 hours of summarized recording. That's the crash code. That's the mind maps getting discussed here. That this is very important, especially in the last days of the exams are left. Okay, topic is notes for easy reference. Okay, and again you have access to the forum. If you're really interested in any of this material, you can contact Austin at edupristine.com. Okay, and or you can visit our website, that is edupristine.com/ca. Hope this session was helpful for you. I'll just keep the slide. Anything you want to note down, you can take it. And thank you for attending this webinar.